Welcome to the Deep Dive. Our mission today, to really crack open the Q3 2025 financial results from Chubb Limited, the global insurance giant. We want to pull out those key insights that tell the real story of how they performed. And this quarter, well, is defined by some pretty spectacular numbers. Core operating income per share, for instance, jumped over 30% year over year, hit $7.49. But if you follow the global property and casualty markets, there's one metric that really stands out, the combined ratio. And for Q3, it clocked in at a record 81.8%.
Yeah, that 81.8%, that's the number everyone's looking at. For you listening, the combined ratio is basically the efficiency score for an insurer. It's pretty simple. For every dollar of premium they bring in, it tells you how many cents they're spending on claims and, well, running the business. Anything under 100% means they're making money just from underwriting risk. So hitting 81.8%, that's exceptionally profitable, and that ties right into the other big figure you mentioned, core operating income. This shows the total earnings from the actual business, both the underwriting, taking on risk, and investing all those premiums they hold. Chubb reported $3 billion in core operating income. That's up, 28.7%?
Almost 29%, yeah.
Exactly. So to really understand the quarter, we need to figure out what levers they pulled to get both those numbers so strong.
Okay, right. Let's unpack that then. What were those dual engines driving that $3 billion income figure?
It really was a tale of two very high-performing areas. So driver number one, underwriting income. That saw just explosive growth. P&C underwriting income hit $2.26 billion. That's a massive 55.0% jump compared to Q3 last year.
55%. Wow.
I know. That's not just, typical growth. That suggests they either priced risk incredibly well, or maybe market conditions just let them push rates way up while keeping claims relatively stable, or both.
Okay, a 55% rise in underwriting profit is definitely astounding. But what about the other engine? Investment income. That's always critical for these big insurers holding huge premium floats.
Absolutely. And the investment side, well, it provided very solid, dependable growth. Pre-tax net investment income came in at $1.65 billion. And the adjusted figure, which smooths things out a bit, hit $1.78 billion. That's up 8.3% year over year.
Still pretty strong, especially given market volatility lately.
Very strong. Consistent performance there.
And just the sheer size of their portfolio means even, smaller percentage moves can have a huge impact on their overall financial health, right? The source material pointed out their book value, the underlying asset base, got a boost of nearly $900 million, $884 million to be exact. That was just from after-tax gains realized and unrealized in the investment portfolio in one quarter.
Yeah, that's pure firepower for their balance sheet, as you say. And we can actually put a number on how effectively they turn that firepower into profit. We look at the annualized core operating return on tangible equity, or ROTE.
ROTE, right. Management's report card.
Exactly. It shows how efficiently they're generating profit from the capital they've actually put to work. Chubb's RTE hit 24.5%. That's up from 21.7% last year. Think about it. It tells you the management team is generating almost a quarter's worth of profit for every dollar of tangible capital they use. Speaks volumes about efficiency.
Okay, so that ROTE figure really sets the stage for that star metric we started with, the combined ratio of 81.8%, 6 points better than last year's 87.7%. But, for those of us trying to figure out if this is sustainable, was it operational brilliance, or did they just get lucky with the weather, fewer catastrophes?
That's the critical question, isn't it? And we absolutely have to separate the, let's say, fortunate events from the real structural improvements. So factor A was undeniably favorable volatility, what we call light catastrophe losses. Total pre-tax CT losses were only $285 million in Q3 this year. Compare that to $765 million in Q3 2024.
Oh, big difference.
Huge difference. That alone significantly pushed down the combined ratio. Less money going out for big disasters.
Okay, so factor A, maybe some good fortune there. But factor B sounds more like skill-favorable development. What exactly is that, and why is it seen as such a good sign for an insurer?
Right. Favorable prior period development. It's basically an accounting benefit that comes from good past claims management. Think of it like this. Maybe last year, Chubb set aside, say, $100 in reserves for a complicated claim they expected to pay out down the road. But this quarter, they actually settle that claim, and it only costs them $90.
Ah, so they get $10 back.
Exactly. That extra $10, the favorable development, flows straight back into this quarter's income statement. It makes the current quarter look better because past estimates were prudent. And for Q3, they booked $361 million in total pre-tax favorable prior period development. That's quite a bit more than the $244 million they had last year.
So they were conservative in the past, and it's paying off now.
Precisely. It shows highly disciplined reserving in prior years. And yes, that caution is paying dividends now, tightening that combined ratio even further.
Okay, but this is where it gets really interesting, I think. Because even Chubb's CEO acknowledged the low CAT losses were a help. But he really emphasized that the real story lies in what happens when you strip out all that volatility, both the good luck on CATs and those reserve releases from the past. So if you take those out, the core P&C current accident year underwriting income was still a very substantial $2.18 billion.
Yeah.
And that was up 10.3%. That seems to be the figure they really want people focused on.
That's exactly right. And the combined ratio that corresponds to the one that excludes CATs in prior period development was 82.5%. Now, that's almost a full percentage point better than the 83.4% they posted in the prior year on the same basis.
Okay, 82.5%.
Yeah, this 82.5% figure, I'd argue, is the cornerstone of the quarter. It really confirms their core business pricing risk, managing claims for this year, is fundamentally getting healthier. It's improving regardless of whether a big hurricane hits Florida or if they release old reserves. The profitability seems structural, and that answers your question about sustainability, I think.
It does, yeah. That makes sense. Okay, so moving from efficiency to just sheer scale.
Yeah.
Are they actually growing this highly efficient machine? Consolidated net premiums written, NPW, were up 7.5% globally. Which segments or regions were the heavy hitters driving that?
Well, the growth was pretty broad-based, which is kind of Chubb's style, that balanced portfolio approach they like. North America NPW overall was up 4.4%. But if you dive into that, you see a really strong domestic consumer focus. Personal insurance grew 8.1%.
8%. So homeowners, auto, people are still paying up.
Seems so. Likely driven by higher property values, maybe needing more coverage, and probably just better risk segmentation on Chubb's part.
And what about the big commercial accounts, the business insurance side in North America?
Right, North America commercial P&C. As reported, it was up 3.5%. However, the source material guides us to look at an adjusted number here. If you account for a couple of one-off items that boosted the prior year's number, the underlying growth rate was actually a very healthy 6.2%.
Ah, okay, so still strong underlying demand and pricing power there too.
Looks like it, yeah.
Now let's shift overseas, because the international segment, Overseas General, seemed to expand even faster.
It did. Overseas General was up 9.7% overall. And mirroring North America, consumer demand was a huge part of that story. Consumer P&C there jumped an impressive 15.5%.
15.5%. Where was that concentrated?
Well, when you look geographically, the picture gets pretty clear. Asia was up 14.3%. Latin America saw a 10.6% increase. So management is clearly finding and executing on opportunities in those higher growth regions, probably tapping into the emerging middle class.
Makes sense. And we can't forget life insurance in all this P&C talk. How did that segment do?
Right, a vital part of their diversification. Life NPW surged 24.6%. That's a big number. And the segment income rose 14.2%. It is important to note, though, nearly 10 percentage points of that top-line growth, 9.9% to be exact, came from a single large one-time transaction in their international life business.
Ah, okay. So a bit of a one-off boost there.
Yeah. The underlying core growth still looks strong, but that particular deal definitely inflated the headline number for the quarter.
Understood. So with all this phenomenal efficiency, the capital generation, the growth, how are they managing all that capital? We're talking billions being generated here.
They're managing it pretty aggressively, actually. They seem to be leaning hard into the idea that their own stock is undervalued. Total capital returned to shareholders just in Q3 was $1.62 billion. That's a massive commitment in one quarter.
And was most of that dividends or buybacks?
Mostly buybacks. That was the clear strategic choice. Share purchases made up $1.23 billion of that total capital return.
Okay. And did they say why such heavy buybacks?
They did. The CEO stated it directly. They believe the stock is trading well below intrinsic value. So you've got a management team using their strong cash flows to basically reinvest in their own company because they think it's cheap.
A sign of confidence, definitely.
For sure. And that decision is kind of reinforced by the underlying balance sheet strength, too. Book value per share actually increased 4.7% just from Q2, sequentially, reached $182.22. Think about that. They're generating profit incredibly efficiently, they're returning huge amounts of capital, and they're still increasing their net asset value per share. It's quite a combination.
Right. So what does all this aggressive activity in these record results imply for the future? What's the outlook they've given the market?
Well, the guidance they're giving is really built on a clear expectation of maintaining, quote, superior earnings growth. They seem to believe this quarter's structural improvements are kind of the new normal. They've laid out some pretty ambitious medium-term goals, too. They're talking double-digit growth in EPS, in book value, and in tangible book value.
Double-digit across the board.
Pretty much. And they're also targeting a core operating return on equity, ROE, increasing to 14% plus over the medium term. They're essentially telling investors, look, expect this level of accelerated performance, this high level of return to continue.
Okay, so to wrap up this deep dive, then let's quick distill the 3 key takeaways listeners should really carry with them from this Chubb quarter. First, I'd say just recognize that historical efficiency shown by the all-in 81.8% combined ratio. That's a headline number.
Definitely. Takeaway number 1.
Second, understand the fundamental underlying health of the core business. That's that 82.5% current accident year combined ratio, the one excluding the volatility. That shows the engine is strong.
Yep. The core strength. That's number 2.
And third, I think, is the aggressive management confidence. You see it signaled by those heavy share buybacks and those really ambitious double-digit growth targets they've just put out there.
Confidence is key, absolutely. And maybe just tying that back to the absolute foundation of any insurance business, the reserves. That massive pool of capital set aside to pay future claims. As of the end of Q3, unpaid losses and loss expenses stood at a staggering $88.4 billion.
Wow.
Yeah. That capital base, that fortress balance sheet, is ultimately what allows them to confidently project this kind of superior earnings growth.
Right. The company's belief in maintaining this growth really seems to rely heavily on those loss reserves being, as the CEO put it, stronger than ever. But here's maybe the challenge, the provocative thought for you to consider. The catastrophe losses just for the first 9 months of 2025 were $2.56 billion. That's significantly higher than the $1.78 billion they faced in the first 9 months of last year, 2024.
Good point. CAAs are up year to date despite a quiet Q3.
Exactly. So the ultimate test, I think, of their operational prowess, of that balance sheet strength, will be whether that underlying 82.5% core result can continue to absorb that kind of increasing top-line volatility from catastrophes moving forward. What really stands out to you? That's it for this deep dive. We hope this knowledge speeds your journey.